Mr. Chairman, we are very appreciative of the time that you have to spend with us this morning, and so without further ado, we'd like to ask you for your thoughts and your comments at this time.
Well, thank you very much, Mr. Chairman. I'd just first like to say, speaking for my colleagues, we very much appreciate your opening remarks, and we find your general view as to longer-term policy something which clearly engages us in a very important debate. Mr. Chairman and committee members, we meet against the background of considerable turbulence in world financial markets, and I shall address the bulk of my remarks to those circumstances. We need to assess these developments against the backdrop of a continuing impressive performance of the American economy in recent months. Growth appears to have remained robust and inflation low and even falling, despite an ever-tightening labor market. Our economy has enjoyed a lengthy period of good economic growth, linked, as you point out, Mr. Chairman, not coincidentally, to damped inflation. The Federal Reserve is dedicated to contributing as best it can to prolonging this performance, and we will be watching economic and financial market developments closely and evaluating their implications. Even after the sharp rebound around the world in the past 24 hours, declines in stock markets in the United States and elsewhere have left investors less wealthy than they were a week ago and businesses facing a higher cost of equity capital. Yet, provided a decline in financial markets does not accumulate, it is quite conceivable that a few years hence we will look back at this episode, as we now look back at the 1987 crash, as a salutary event in terms of its implications for the macroeconomy. The 1987 crash occurred at a time when the American economy was operating with a significant degree of inflationary excess that the fall in market values arguably neutralized. Today's economy, as I have been suggesting of late, has been drawing down unused labor resources at an unsustainable pace, spurred in part by a substantial wealth effect on demand. The market's net retrenchment of recent days will tend to damp that impetus, a development that should help to prolong our 6.5-year business expansion. As I have testified previously, much of the stock price gain since early 1995 seems to have reflected upward revisions of long-term earnings expectations, which were implying a continuing indefinite rise in profit margins from already high levels. I suspect we are experiencing some scaling back of the projected gains in foreign affiliate earnings, and investors probably are revisiting expectations of domestic earnings growth. Still, the foundation for good business performance remains solid. Indeed, data on our national economy in recent months are beginning to support the notion that productivity growth, the basis for increases in earnings, is beginning to pick up. I also suspect earnings expectations and equity prices in the United States were primed to adjust. The currency crisis in Southeast Asia and the declines in equity prices there and elsewhere do have some direct effects on U.S. corporate earnings, but not enough to explain the recent behavior of our financial markets. If it was not some developments in Southeast Asia, something else would have been the proximate cause for a reevaluation. While productivity growth does appear to have picked up in the last 6 months, as I have pointed out in the past, it likely is overly optimistic to assume that the dimension of any acceleration in productivity will be great enough and persistent enough to close by itself the gap between an excess of long-term demand for labor and its supply. it will take some time to judge the extent of a lasting improvement. Regrettably, over the last year, the argument for the so-called new paradigm has slowly shifted from the not unreasonable notion that productivity is in the process of accelerating to a less than credible view, often implied rather than stated, that we need no longer be concerned about the risk that inflation can rise again. The Federal Reserve cannot afford to take such a complacent view of our price prospects. There is much that is encouraging in the recent performance of the American economy, but as I have often mentioned before, fundamental change comes slowly, and we need to evaluate the prospective balance of supply and demand for various productive resources in deciding policy. Recent developments in equity markets have highlighted growing interactions among national financial markets. The underlying technology-based structure of the international financial system has enabled us to improve materially the efficiency of the flows of capital and payment systems. That improvement, however, has also enhanced the ability of the financial system to transmit problems in one part of the globe to another quite rapidly. The recent turmoil is a case in point. I believe there is much to be learned from the recent experience in Asia that can be applied to better the workings of the international financial system and its support of international trade that has done so much to enhance living standards worldwide. While each of the Asian economies differs in many important respects, the sources of their spectacular growth in recent years, in some cases decades, and the problems that have recently emerged are relevant to a greater or lesser extent to nearly all of them. Following the early post-World War II period, policies generally fostered low levels of inflation and openness of their economies, coupled with high savings and investment rates, contributed to a sustained period of rapid growth, in some cases starting in the 1960s and 1970s. By the 1980s, most economies in the region were expanding vigorously. Foreign net capital inflows grew, but until recent years were relatively modest. The World Bank estimates that net inflows of long-term debt, foreign direct investment, and equity purchases to the Asia-Pacific region were only about $25 billion in 1990, but exploded to more than $110 billion by 1996. A major impetus behind this rapid expansion was the global stock market boom of the 1990s. As the boom progressed, investors in many industrial countries found themselves more heavily concentrated in the recently higher valued securities of companies in the developed world, whose rates of return in many instances had fallen to levels perceived as uncompetitive with the earnings potential in emerging economies, especially in Asia. The resultant diversification induced a sharp increase in capital flows into those economies. To a large extent, they came from investors in the United States and Western Europe. A substantial amount came from Japan as well, owing more to a search for higher yields than to rising stock prices and capital gains in that country. The rising yen through mid-1995 also encouraged a substantial increase in direct investment inflows from Japan. In retrospect, it is clear that more investment monies flowed into these economies than could be profitably employed at moderate risk. I suspect that it was inevitable in those conditions of low inflation, rapid growth, and ample liquidity that much investment moved into the real estate sector with an emphasis by both the public and private sectors on conspicuous construction projects. This is an experience, of course, not unknown in the United States on occasion. These real estate assets, in turn, ended up as collateral for a significant proportion of the assets of domestic financial systems. In many instances, those financial systems were less than robust, beset with problems of lax lending standards, weak supervisory regimes, and inadequate capital. Moreover, in most cases, the currencies of these economies were closely tied to the U.S. dollar, and the dollar's substantial recovery since mid-1995, especially relative to the yen, made their exports less competitive. In addition, in some cases, the glut of semiconductors in 1996 suppressed export growth, exerting further pressures on highly leveraged businesses. However, overall GDP growth rates generally edged off only slightly, and imports fostered by rising real exchange rates continue to expand, contributing to what became unsustainable current account deficits in a number of these economies. Moreover, with exchange rates seeming to be solidly tied to the dollar, and with dollar and yen interest rates lower than domestic currency rates, a significant part of the enlarged capital inflows into these economies, in particular short-term flows, was denominated by the ultimate borrowers in foreign currencies. This put additional pressure on companies to earn foreign exchange through exports. The pressures on fixed exchange rate regimes mounted as foreign investors slowed the pace of new capital inflows, and domestic businesses sought increasingly to convert domestic currencies into foreign currencies, or equivalently, slowed the conversion of export earnings into domestic currencies. The shifts in perceived future investment risks led to sharp declines in stock markets across Asia, often on top of earlier declines or lackluster performances. To date, the direct impact of these developments on the American economy has been modest, but it can be expected not to be negligible. U.S. exports to Thailand, the Philippines, Indonesia, and Malaysia, the four countries incidentally initially affected, were about 4% of total U.S. exports in 1996. However, an additional 12% went to Hong Kong, Korea, Singapore, and Taiwan, economies that have been affected more recently. Thus, depending on the extent of the inevitable slowdown in growth in this area of the world, the growth of our exports will tend to be muted. Our direct foreign investment in and foreign affiliate earnings reported from the economies in this region as a whole have been a smaller share of the respective totals than their share of our exports. The share is nonetheless large enough to expect some drop-off in those earnings in the period ahead. In addition, there may be indirect effects on the American real economy from countries such as Japan that compete even more extensively with the economies in the Asian region. Particularly troublesome over the past several months has been the so-called contagion effect of weakness in one economy spreading to others as investors perceive, rightly or wrongly, similar vulnerabilities. Even economies such as Hong Kong, with formidable stocks of international reserves, balanced external accounts, and relatively robust financial systems, have experienced severe pressure in recent days. One can debate whether the recent turbulence in Latin American asset values reflect contagion effects from Asia, the influence of developments in U.S. financial markets, or homegrown causes? Whatever the answer, and the answer may be all of the above, this phenomenon illustrates the interdependencies in today's world economy and financial system. Perhaps it was inevitable that the impressive and rapid growth experienced by the economies in the Asian region would run into a temporary slowdown or pause. But there is no reason that above-average growth in countries that are still in a position to gain from catching up with the prevailing technology cannot persist for a very long time. Nevertheless, rapidly developing free market economies periodically can be expected to run into difficulties because investment mistakes are inevitable in any dynamic economy. Private capital flows may temporarily turn adverse. In these circumstances, companies should be allowed to default, private investors should take their losses, and government policies should be directed towards laying the macroeconomic and structural foundations for renewed expansion. New growth opportunities must be allowed to emerge. Similarly, in providing any international financial assistance, we need to be mindful of the desirability of minimizing the impression that international authorities stand ready to guarantee the liabilities of failed domestic businesses. To do otherwise could lead to distorted investments and could ultimately unbalance the world financial system. The recent experience in Asia underscores the importance of financially sound domestic banking and other associated financial institutions. While the current turmoil has significant interaction with the international financial system, the recent crises would arguably have been better contained if long maturity property loans had not accentuated the usual mismatch between maturities of assets and liabilities of domestic financial systems that were far from robust to begin with. Our unlamented savings and loan crisis comes to mind. These are trying days for economic policymakers in Asia. They must fend off domestic pressures that seek disengagement from the world trading and financial system. The authorities in these countries are working hard, in some cases with substantial assistance from the IMF and the World Bank and the Asian Development Bank, to stabilize their financial systems and economies. The financial disturbances that have afflicted a number of currencies in Asia do not, at this point, as I indicated earlier, threaten prosperity in this country. But we need to work closely with their leaders and the international financial community to assure that their situations stabilize. It is in the interest of the United States and other nations around the world to encourage appropriate policy adjustments and, where required, provide temporary financial assistance. Thank you, Mr. Chairman. I look forward to your questions.
And Dr. Greenspan, thank you very much for a very thorough and articulate statement involving the situation that we find ourselves in. Mr. Chairman, during your statement you mentioned at some length the situation involving the Asian developing countries, and if I interpreted what you said correctly, you indicated that what we're seeing is hopefully, perhaps probably temporary in nature in terms of a setback. We also know that despite the recent volatility shown in the U.S. stock market, that economic growth appears to be solid and that unemployment and inflation remain quite low. And given the economic fundamentals and given the analysis that you have just related to us relative to the Asian developing countries, shouldn't we expect the outlook for the economy to be quite positive in the foreseeable future?
You're talking about the American economy, our economy.
Yes, sir.
Yes, I think so. Indeed, it's very difficult to come to a conclusion looking at the data that continues to come in that this economy cannot continue to grow in a solid and hopefully non-inflationary manner. I indicated in my testimony that as of things now stand, the repercussions from the difficulties in Asia, while they do impact upon our exports, they doubtless impact on some of the prices that domestic producers charge in this country and have additional marginal effects. The impact is relatively modest. Our concern is that the contagion that has occurred be contained. And the reason for that is that with the evolution of what really is an extraordinarily dynamic international financial system, which has emerged really in the last decade or less, there is a new pattern of flows of capital which have become extraordinarily large. And while it is clearly required to facilitate the expansion of international trade in goods and services and standards of living, it is something new that we have to focus on and understand. I would think that as in all open economies and all free markets, people don't bat 1,000% in their investment judgments, that they make mistakes, hopefully fewer than the correct decisions, but they do make mistakes, and periodically that is going to cause retrenchments. They should be temporary, there should be a pause, and as the mistakes are liquidated, growth picks up again, new products emerge, economies become better, standards of living rise. That is the process which I think that we in the United States should be very focused on to assure it continues in a balanced manner, because we are one of the major recipients of the benefits of that very effective international financial system.
Let me just follow up, and I don't want to be repetitive. I did refer to this in my opening statement, but with regard to our domestic economy, you have made it a central focus of your chairmanship and of the Federal Reserve policy to focus on a part of our economy that we generally refer to as inflation or price stability. In recent congressional testimony, you stated that low inflation, quote, was a cause of a good economy. You said continued low levels of inflation and inflationary expectations have been a key support for healthy economic performance. They have helped to create a financial and economic environment conducive to strong capital spending and long-range planning generally, and so to sustained economic expansion. Consequently, the Federal Open Market Committee believes it is crucial to keep inflation contained in the near term and ultimately to move toward price stability. This seems to me to be a concept that's extremely important in our economy today, and doesn't this suggest that lower inflation leads to lower interest rates, and that lower interest rates lead to economic expansion in much the same way that some of us like to think about lower taxes leading to economic growth? Isn't this all kind of sort of the same policy?
I think so, Mr. Chairman. I think that especially as we are experiencing month after month of low inflation and observing the concurrent strength that is being exhibited by the economy, statisticians are going to find increasingly that the relationship between low inflation on the one hand and increasing productivity on the other is going to become an ever tighter relationship. I suspect, although at this particular stage we can't prove definitively, that strong economic growth which persists indefinitely requires low inflation as a necessary condition. If that is the case, then the notion that we would allow inflation to reemerge in this country and undercut, which has been one of the most successful economic expansions that I've experienced in my working life, to allow that to happen, I think would be a very tragic event. And as I've stated innumerable times before this Congress, the policy of the Federal Reserve has to be to sustain low inflation and price stability if our objective is maximum long-term sustainable growth.
Mr. Chairman, as you know, the United Kingdom and Canada and Sweden and central banks in those countries have adopted formally a policy of targeting inflation. And as you know, I have introduced a price stability bill mandating the use of inflation targets, a narrow band of permissible increases in a broad price index measure would be chosen and disclosed by the central bank, as is already the case in the nations that I mentioned and obviously quite a few others. The definition of price stability in terms of inflation targets is a balanced approach that establishes a firm constraint on inflation but permits a good deal of flexibility. This seems to be consistent with recent Fed policy pursuant to your chairmanship. Is this the kind of definition of price stability a promising approach? Obviously, following on your comments of a few minutes ago, I would think so. And do you see, obviously you're not going to be the chairman forever, and I'm not going to be in this seat forever. Some people may be happy about this seat. I'm not sure that.
I can assure you there are a lot about who would feel the same about this seat.
I'm curious. It appears that that this economic theory is valid. It appears that it has worked in other countries. It appears that since during this decade, let me put it that way, it has worked in this country. And is it something that you believe that as policy makers we might pursue to formalize in some way?
Mr. Chairman, the answer from my point of view is yes, as I've indicated to other members, including Senator Mack, who has had a bill which is not dissimilar to yours. There is a dispute within the question of the focus on inflation and employment. My impression is that we may be resolving that dispute merely by the accumulation of evidence that inflation is such a crucial factor in the sustaining of employment. Low inflation sustaining long-term employment growth. I think this is a debate which would be very valuably engaged in the Congress, and I think it would be quite useful to get numbers of people's views on the particular aspects of your bill, because I think it's only in that way that it can be put on the table and thoroughly debated. But I certainly agree with the general thrust of your remarks, and I must say I personally would probably be a fairly strong supporter of the thrust that you're initiating.
Thank you, Mr. Chairman. Yes, you're right. Senator Mack and I have worked together on this approach with certain adjustments in our legislation from time to time, but it has been rewarding to work with the senator, actually following his leadership to some extent with regard to this subject. We have a chart over on the side here which demonstrates the result, or at least a parallel occurrence. The yellow line on the chart, which goes back about a decade, shows what has happened with inflation as measured by the cost, the consumer price index, which obviously shows a downward path. And the rate of unemployment demonstrated by the red line shows a very similar downward path. And so it's very encouraging to see that these policies relative to inflation targeting and squeezing inflation out of our economy have produced the positive kinds of effect that both employers and workers alike have benefited from. As I mentioned a few minutes ago, and I'll ask just one last question on this subject and then leave it at that. I mentioned that many central banks in other countries have successfully adopted these inflation policies. Most of these countries have significantly lowered their inflation rates since introducing their targets, and I'm glad to know that that you believe that this is the kind of policy that we should pursue as well. Let me just ask this question. What do you believe are the primary lessons to be learned from the international experience with inflation targeting? Are they similar to ours?
It's not unequivocal in the sense that I think you're quite correct in which you state that those that have put on inflation targets have seen lower inflation, but many others who haven't put on inflation targets have also seen lower inflation. So it's only when we begin to see divergences that you can get a really significant test as to the extent to which the inflation targets themselves create other collateral policies which actually foster lower inflation or price stability.
Just as a follow-up, when you mentioned that we perhaps have not formally put on inflation targets, but certainly informally the thrust of the Fed over the last decade has been to do just that, perhaps in an informal way. Would you agree with that?
I would certainly agree with that, Mr. Chairman.
Thank you very much. Senator Bingaman, I've completed my line of questioning for now, and we'll turn to you.
Thank you very much, Mr. Chairman. Chairman Greenspan, thank you for your statement. On several previous occasions recently, in the last year or so, I think you indicated your belief that equity markets were overpriced. Has anything happened in the current circumstances or recent circumstances to change that view?
Well, I never actually said they were overpriced. What I did say is that the various elements which were being implicitly projected by the level of stock prices had, in my judgment, a less than 50-50 probability of occurring. It's always a very tricky question to determine whether stock prices are overvalued or not. All you can really do is infer what a particular level of stock prices implies about, one, the expected growth rate in earnings and or what economists call the equity premium in stock market, in markets. That is, it's the yield spread over the long run of what a stock will yield over a riskless debt instrument. All you can say is whether or not the implicit growth rates of earnings, and we do have data on security analysts' forecasts, are reasonable or unreasonable, and very specifically, whether the equity premiums are within a reasonable range so far as history is concerned. As I've said previously, I've thought that the significant upward revisions in long-term earnings growth implied a very beneficent outlook for earnings. I think there's been some adjustment in that recently, and clearly to that extent I would have to conclude that things are less out of line, certainly, than they would have been in my judgment. I would hesitate to give you a view as to exactly where the probabilities lie, because as I pointed out in my prepared remarks, we are finally beginning to see some evidence in the data that a crucial element in that whole notion of earnings growth, namely productivity growth, is exhibiting some elements of acceleration. Whether it is temporary, whether or not it's reflecting some of the longer-term forces which I outlined in earlier testimonies is as yet too soon to tell, and we probably won't be able to tell for a while. But it's, I think, very encouraging that the productivity numbers look as they do, because it's essentially that which has enabled us to produce an economy with fairly solid growth without inflation showing any significant reemergence.
Let me ask about imports. You speak in your statement about exports and how our exports, particularly to the Far East, will be, the growth in our exports, I believe you used the phrase, will be muted as a result of the changes that have occurred there in their economies. What about imports? Would we also see a reduction of or downward pressure on inflation in this country and perhaps on prices as a result of substantial increases in imports from that part of the world?
I would doubt if we're going to see substantial increases in imports per se. We'll see some, because obviously with their exchange rates lower, they can price in at a lower level into American markets. I think the major impact is far less likely to be any really significant imports, but I do think that they do affect the world price level, and for a lot of different commodities, and to that extent, it probably does filter in here. Remember that unlike other economies which are more manufacturing goods related, we are increasingly a service economy, and that of the business sector, manufacturing is roughly a third or less of what it is that we produce in the way of overall goods and services. And as a consequence of that, we're dealing with a situation in which, while we see a fairly constrained price level for goods in this economy, in other words, the CPI for commodities only is rising far less than the elements of the CPI which comprise services. To the extent that we are getting the types of imports and import price effects, it impacts largely, not wholly, but largely on goods only. And therefore, it is not a profoundly important impact. I think it does work at the margins. I think it's important for numbers of individual companies. I would be quite surprised if it turned out to be anything other than a marginal effect.
In the 1980s, we had a period which I thought at the time the dollar seemed to be overvalued relative to other currencies, and there was great difficulty that many of our companies had selling into or maintaining market share in world markets because of the very high value of the dollar, particularly relative to the yen. Are we in danger of having another period like that now, with the devaluation of currencies that's occurred and with the strong dollar that we've got?
I would doubt it very much, Senator. The period just prior to February 1985, which is when we reached the peak of the dollar vis-a-vis the other currencies, was really quite a distorted financial period. And we had a number of things going on, including, as you may recall, a very large federal government deficit that don't exist today. So I would be far more relaxed on that question at this particular stage. I don't deny that we have to monitor the movements in exchange rates, because as the economy becomes increasingly more internationally oriented, our exchange rate does have an increasing impact on everybody. But I don't perceive of any distortions arising which could create the type of concerns that you express.
My last question would be with regard to interest rates and Fed policy on interest rates. Do you see The recent events that you've described at length in your statement to increase the prospects that the Fed would look in the future to lower interest rates rather than to raise them? Or do you still think the concern would be about a need to raise interest rates?
Senator, I don't know of any way I can answer that question without getting myself in trouble.
I just thought I'd ask.
Senator Bingaman, thank you very much. I was intrigued particularly by the question you asked relative to the relative value of currency. It obviously is a concern that many of us have had, and we're comforted to a large degree by the Chairman's comments. Turn now to the gentleman from Texas, Mr. Thornberry.
Thank you, Mr. Chairman. Chairman Greenspan, I think in many ways one of the most striking things to many of us about the events of this week is the interdependence of the economies of various nations. And you talk in your statement about the contagion effect being particularly troublesome. And in some ways one wonders whether this interdependence is in part taking our ability to shape our economy out of our own hands. Maybe the decisions of the Fed, the decisions of Congress have less importance as decisions and things that happen in other countries play a bigger role. I'm wondering if you have suggestions about structural or policy changes that we should look at to at least try to prevent the downside of that phenomena from impacting on our economy. And I think all of us are troubled if we see instances of rumors or hints or other kinds of factors other than underlying economic fundamentals playing such a tremendous role as they can in the volatility of these markets, and certainly suggestions you have on how we focus on the things that matter and try to discount the things that don't matter, I think would be helpful to us.
Mr. Thornberry, I think that we are moving towards a world in which the major changes in technology, as I mentioned earlier, are going to alter the way we look at the way we do business, the way we produce goods and services. And we have to adjust to that. Our choice is really this. We or anybody else can put barriers around your country. We can insulate ourselves fully, if we wanted to, from all of the contagion effects, from all of the import problems, we could do that. The cost would be a very dramatically lower standard of living. We would have stagnation, effectively. The alternative is to address this really dramatic, dynamic international system and capture the really quite impressive benefits that it offers. And as I indicated earlier, I think we in the United States probably are at the cutting edge of where those benefits are. There is a cost, and the cost is that we're running against potential types of errors which get magnified. And I think the point you raise is exactly right. We shouldn't make the choices to go back, but how do we make the going forward as productive and as least subject to crisis as possible? We're not going to be able to fully remove fluctuations and crises from the market. That's in the nature of markets. In other words, they fluctuate, they sometimes are in turmoil. That's the result of the fact that you cannot bat 1,000% in investment decisions. I don't mean portfolio or stock. I mean in whether you build a building here or a plant there. Because of that, there is periodic periods of turmoil. We should accept that as essentially the normal, but make certain that we have mechanisms in the international financial system which contain them and prevent the contagion which spills over and alters what is just a normal ongoing correction into something far worse. I think we at the Fed and our colleagues at the Treasury have been spending quite a good deal of time focusing on precisely this issue in recent years, and especially, obviously, in the most recent period. I don't know we'll come up with exactly the right answers. I don't know that in conjunction with the very considerable discussions we were having with our counterparts abroad, we're going to get down to the bottom line and get it exactly right. But we are trying, and I must say I am somewhat encouraged about the progress that's being made in recent years on this issue.
One of the key points you make, somewhat related to that, is that essentially we have to let investors take their losses and move on, but one of the things that we have to do is minimize the impression that international authorities stand ready to bail people out. There have been some former cabinet secretaries that have recently called, for example, for the IMF to be abolished, that it is outlived its usefulness, at least in its current form. How ready is the international financial system to deal with the way that things are now and the direction that they are going? And do you have suggestions for us about improvements, modernization, updating of at least our role in some of those institutions?
I think it's becoming ever more apparent that the problems that give us the most concern in the international sphere turn out to be largely domestic problems, meaning the crises which we've experienced in recent years seem to almost invariably end up with some problem in the domestic banking industry. And that suggests to us that what is quite important to get a far greater formidable infrastructure in the international financial system, to find ways to assure that banking and finance generally is put in a very sound and secure manner, which is not the case in a large number of countries. Learning that lesson suggests to us that indeed the International Monetary Fund does have a role. It's a new role. It's not the one which the Bretton Woods Conference created, and I think those who argue that that role is gone are quite correct. It turns out that I think we do need some international presence of the type that the IMF has put into place, and I think we can do, I think that if we focus on the roles, a new role for a new institution, and there's no reason why it cannot be the International Monetary Fund, as indeed it has been in recent years, as they have shifted their focus in a manner which, while we may not always agree with them in everything they do, in general, I think has been productive.
Thank you.
Thank you very much, Mr. Thornberry. If I may, at this point for the members, we are, because of the number of folks who have fortunately come this morning, we are operating pursuant to the 5-minute rule, and the little green and red lights there are indicators of expirations, unfortunately, of time. So if we could all try to keep our questions to 5 minutes, it would be appreciated, I'm sure, by everyone here. Let me turn now to the gentleman from New York, Mr. Hinchy.
Well, thank you very much, Mr. Chairman, and Mr. Greenspan, thank you very much for being here, and thank you for your statement. I found it very interesting and very revealing, and in spite of its sort of Darwinian overtones with regard to the world markets, particularly those in the Far East, I think very, very helpful, as you always are when you appear before either this committee or one of the other committees, and I very much appreciate that. I also want to express my appreciation to you for the moderate approach that you seem to have taken within the committee meetings. As near as we can decipher the minutes coming out of the meetings, you seem to have been a force arguing against some of the other members of the committee in their interest in wanting to raise interest rates, and you seem to have been wanting to calm that down, and to the extent that that is the case, I want to express my appreciation to you for that also. The irony, of course, is that just a few weeks ago, when you were before the, I think it was a Senate Budget Committee at that time, you made some statements about that were construed to mean that there may be some cause for raising interest rates, and of course that caused the market to drop by 100 points the next day. So I am particularly, in the context of what we've seen recently, absolutely fascinated about this total devotion to price stability, when it seems to me that others in the world now are talking about the need to stimulate growth. We know that we have had the benefits of this economic expansion now since sometime around the end of 1992, and the effects of it have been very, very beneficial. But those benefits have not expressed themselves universally within our society. Corporate profits are up by 60%, yet wages in that period of time, which affects most of the people in this country, are up by only 1.5%. So the fixation on price stability at the expense of growth is one that I find just absolutely remarkable. I would appreciate your views on that, particularly in light of what you seem to have said in response to some of the questions that were raised earlier, that there seems to be a need to focus more attention on price stability and less on full employment. And the effects of that full employment would bring to our economy.
Mr. Hitchie, I am increasingly of the view that there is no important trade-off here over the longer run, and I think most economists would agree with that. Would it be nice or desirable if instead of the growth rate we have, whatever it is and however it is measured, it were twice what it is? Obviously. I don't think that's the question. I think the question that we must confront is whether, in fact, the existing economic expansion, which is about as solid as any I've seen, one that has drawn the people who, one, are unemployed officially because they report to the Bureau of Census, the Bureau of Labor Statistics, rather, that they had sought a job in the previous month, and a not insubstantial number of people who are technically outside of the labor force and say they want a job. The sum total of those two groups have been falling very dramatically in the last year or so, and are now at levels which are lower relative to their populations than any time as far back as the data go. This has had some very positive effects in this economy. I think that it has created levels of job skills of people who would not have been able to have achieved them otherwise. I think it has assisted welfare reform immeasurably. It has all different types of advantages which we can cite, including, I think, significant recent increases in real wages and a definite slowing in the degree of income distribution which we've discussed previously. I think that it is terribly important for us to make sure that this recovery continues and continues in a solid way. I think the greatest threat to it at the moment, as I've argued in previous fora, is the onset of inflation, which could destabilize the system, create unemployment, and effectively reverse much of the benefits that have occurred. If I thought that deflation were emerging, and indeed was a threat to the recovery that we're looking at, I would say that would be something we should be focused on just as resolutely. It's just that the analysis at this stage suggests that that is not the case. It could be the case, and it's not something which I would dismiss out of hand. We talk about price stability, not anti-inflation. If If you want to be anti-inflation, the best way to be anti-inflation is to have your price level go down 20% a year. That is not what price stability means. We believe that we should be as forceful against the emergence of deflation as inflation. It just happens that at this particular time, the concerns which grab our attention as a result of the analysis of the various forces that are going on in the economy stress that it is inflation, not deflation, which is a crucial element which serves as the major threat to this expansion.
Well, of course, there's inevitably going to be disagreement about that, and there are many economists who disagree, as I disagree heartily with what you just said. I think that we are on the verge of a situation where, in fact, it may be deflation that is the enemy. Inflation today, as you know, is half of what it was just last year. There is no indication of inflation anywhere in the economy. And it was argued recently at your committee meeting that by historical standards, interest rates now are high, by historical standards, higher than they need to be. And it seems to me that we ought to be looking more at how to share the benefits of this economy with more and more people, how to get the economy to grow at a faster rate. I'm particularly concerned in the context of the global economy. It has been projected that our growth rate next year, that is the United States growth rate, may fall to as low as 1.5%. If the problems in the Far East persist, as they give indications they may, as the Europeans continue to struggle with the need to complete the requirements of the Maastricht Treaty and lower their deficits below 7% of GDP, I wonder where this world economy is going unless we begin to concentrate our efforts on the need to promote more growth than we currently have and to involve more of our people in the benefits of that growth. And I would love to hear your comments on that.
Well, I would certainly like to see as much benefit as we can get, and I'd like to see as much growth as we can get. The question is a factual issue as to where threats are. None of us can forecast the future with accuracy. We're all making judgments about what probabilities are, and some of us have far more experience in certain areas than others. Some of us are, I would say, I'm talking about within the Federal Reserve, I would say some of us are arguing points not dissimilar to the points that you're making. That's part of the basic discussion. I don't know what I can say other than the fact that most of us at the Federal Reserve disagree with the position you're taking. Is it a respectable position? Certainly. I mean, if we see the types of forces that you're seeing, we'll change. The point of this is we don't see them. It's not because we're not looking very forcefully. I do not deny that there are a lot of economists out there who are raising these issues. It's one of the more interesting, difficult problems analytically that we have so far as monetary policy is concerned. But it's a really very fortunate problem. We're looking at how to continue what has really been a very successful economic expansion. That is a far more desirable debate than how does one catch up to a crisis when you're behind the curve and you can't figure out what the consequences of what you're doing are. So to be sure, I think there is a debate here. There are good arguments on both sides. Because neither group can forecast the future with certainty, the award of who is accurate cannot be produced in advance. But I think reality will confront us eventually, and the answer to your question will come out unequivocally one way or the other.
Mr. Hinchey, Maurice, thank you very much. A discussion of economics would not be complete without differing points of view, and we appreciate your articulating your point of view. I'd just like to take a moment to once again refer to the chart here to show at least from an economic unemployment rate point of view, as inflation has come down, so too has the rate of unemployment quite dramatically. And while we'd all like to see higher wages, certainly that's the American way and the American dream. We hope we'll get to that as we proceed through this period of expansion. The gentleman from Illinois, Mr. Ewing.
Chairman Greenspan, thank you for your comments. Thank you for the time they're spending with us at this very important time financially here in America. I want to change the questioning just a little bit, and would first by saying that this week's market movement had impacted the Dow Jones futures contracts traded on the Chicago Board of Trade in Illinois, and the S&P 500 traded on the Chicago Mercantile Exchange. Both exchanges initiated trade halting procedures on Monday. In your opinion, do you believe the circuit breaker on the futures exchange worked as intended?
Mr. Ewing, I think there's going to be a number of doctoral theses written on this subject in the year ahead, because this is the first real test that we have seen. I can probably with some confidence conclude that the results will be inconclusive. And the reason is that there are lots of different forces involved. There are strong arguments on both sides of this. My own personal view has never been wholly friendly to circuit breakers or stopping markets, because I'm always concerned as how in the world are you going to get them started again. But that view is countered by many who claim that indeed there are significant benefits. There have been recent surveys about what the innumerable various related types of activities. As you know, there are limits on the Chicago Board of Trade on all agricultural commodities and the like, which is sort of a somewhat similar thing. And we do have program trading alterations, as you know, when the Dow Jones Industrial Average moves 50 points in either direction. The analyses of these have not been conclusive one way or the other. So I'm not sure we're going to find very much unanimity on this issue. I think you're going to find that most brokers, most traders would prefer that you kept the markets open. You'll often find others who would not. And I'm certain that I would, as I said, I come out more on the side of leaving markets open and let them trade, but I suspect the average probably is right smack in the middle.
You might feel then that by halting this trading that we have limited liquidity. That's one of the arguments.
Well, that's one of the purposes, actually. It's to actually slow the process down, and the presumption is that people who are going to be rashly running to sell or to buy would have second thoughts and would change them. The problem is that there are others who, when you shut them down, have claustrophobia and decide that all of a sudden they want to get out, and as soon as you open the door, they're gone. So it's a question of which force is the most dominant to determine which price effect occurs.
We currently have a prohibition on trading individual stock futures. Had individual stock futures been traded this week, would there have been a negative, positive, or indifferent effect on the market?
Mr. Ewing, that's almost a question like monetary policy. Anything I can say on that issue will create more enemies out of friends and vice versa, and I don't have enough friends, so that I think I'd better stay put. As you know, there is a very strong view in the New York Stock Exchange against that, and a very strong view in the futures markets for it. And it's an argument I'd probably, as a private citizen, love to get involved in, but I see no necessity as a central banker to have to answer that question.
Well, I'll try and throw a softball. There is legislation in both the Senate and the House that would free up the regulations of our futures markets with the concern that we need to be competitive in the world markets. Would you have a comment on that? That legislation is stalled, I think, really in both houses as far as moving this year.
Yeah, which particular part of the legislation are you referring to?
Well, the pro-market provisions of the legislation, which allow the markets to operate with less regulation, such as some of the foreign markets are.
Yeah, this is the CFTC.
Yes, yes, that's
yes. I've been supportive of that, and I think that it gets to a lot of complex legal issues with respect to what constitutes a derivative, what constitutes a future, and who has regulatory authority between the CFTC and the Securities and Exchange Commission. And I've been concerned that we not too rigorously define these things in a manner which would undercut the so-called over-the-counter market in derivatives, which is a very important force developing in this international financial system, which I've discussed earlier and think is crucial to the continued expansion of international trade. So I'm personally quite supportive of those measures because I think that to get these issues clarified and get a broader capability of competition going is in this nation's interest.
Thank you very much.
Thank you, Mr. Ewing. We'll turn now to the gentlelady from New York, Ms. Maloney.
Thank you, Mr. Chairman. Welcome, Mr. Greenspan, and thank you for your leadership. You mentioned earlier that you believed that we need an international presence like the IMF to help stabilize markets in Asia. Do you believe that the American government should be increasing its participation in the IMF? Should we be loaning more to the IMF to help us with this particular problem? And secondly, will the Fed be making swap loans, federal loans available to the Asian countries?
We have supported Treasury's initiatives with respect to elements specifically in the Function 150 categories in the budget and in its initiatives with respect to our relationships with the International Monetary Fund and the World Bank. We have not been involved, the Federal Reserve, in swap arrangements, as you are aware. I can't say where or what we might do in the future. I would say, however, that were we or the Treasury to be involved in any such assistance, it would be because it was perceived to be in the interests of the United States. In fact, I think the law effectively requires that.
Okay. Following up on Senator Binghamton's question on possible actions for future inflation. Yesterday, the Bureau of Labor Statistics reported that the employment cost index, the average cost of employing a worker, rose 0.8% in the third quarter of 1997, which amounts to a rise of 3% over the last 12 months. A wire story said yesterday that this news, and I quote, isn't good for the Federal Reserve. Fed Chairman Greenspan said recently that trends in the labor market indicate the labor market has been on an unsustainable track, end quote, and you brought that up in your testimony today. Meanwhile, research from many sources, including a September 1997 article from the Federal Reserve Bank of New York and a 1993 article by a Federal Reserve researcher, are very inconclusive about whether a rise in wages leads or follows increases in product prices. The Federal Reserve Board of New York's research concludes that the increase in the wages of workers in production industries, that is not in the service sector, is not related to inflation. Would you clarify your position on this issue? Are you using the employment cost index as a primary signal of future inflation?
No. And first of all, I suspect that, as I recall the New York Federal Reserve Bank issue, they were referring to the question as to whether or not you can use wages as a statistical indicator for future inflation. I think that most of the econometric analysis that you can work with creates all sorts of problems, which leads which. It's a simultaneous process that works. The issue that I have been raising is a question of what the facts are. The facts are that the rate of growth in employment over recent years has been such that we have had to dig ever increasingly into a group of people who are not working but wanted a job, to the point, as I mentioned earlier, that the sum total of the unemployed plus those who are not in the workforce but would like a job, the sum of those two have gotten increasingly lower. I am merely drawing the obvious arithmetical problem that if that trend continues, that something has to give. I mean, we do at some point run into some pressures. And while one can very appropriately argue that you can define inflation beginning without any wage relationship at all. For example, if oil prices are spiked higher, that will engender inflation. It may pull up wages because of the required escalators in a number of different contracts. Alternatively, you can create a scenario in which indeed it is an increase in wages if they rise faster than the rate of productivity as a force creating inflation. Nominal wage increases per se, without advertence to what the corresponding increase in productivity is, will tell you little, if anything, about the inflation process. So the question really gets down to the difference between wages and productivity. I am merely saying that, which was what these facts, in my judgment, irrevocably communicate, is that you just cannot continuously reduce the level of people who are willing to work without either running out of that group of people or well before then finding that in order to induce other people to work that the wage structure must go up. If that goes up in line with productivity, it is not inflationary. If it goes up more than productivity, meaning unit labor costs go up, it begins to put pressure on prices. It's very difficult to get out of that analysis. The question is which causes what under what conditions, and I will say that it varies. It doesn't, I wouldn't argue that wages per se cause inflation, nor would I argue that inflation causes wage increases. I think it's an interactive process, and you need far more information than that particular fact to know what the outcome is likely to be.
Thank you.
Thank you very much, Ms. Maloney. For those who may be casual observers of the Joint Economic Committee, we get our name Joint Economic Committee because, as you noted, Senator Bingaman, the ranking member, is a senator. We also have another senator, a very thoughtful gentleman from the state of Utah, Mr. Bennett. Senator, you may ask your questions.
Thank you, Mr. Chairman. Chairman Greenspan, we won't force you to sit there while we debate economics back and forth among ourselves, but I can't resist making a comment that I ran a business during the great inflation of the late 1970s. Remember, a political commentator said it's the only time in history where the president's approval rating was lower than the prime rate. I've had the experience of borrowing money at 21%. And I also ran a business during the time of of sustained growth of the kind you have described here. And I found it much easier to create jobs during the time of sustained growth than when I had to go to the bank and borrow money at 21%. So I think you ought to stay firm on your position with respect to the importance of price stability and the importance of sustained growth as the way to solve the unemployment problem, rather than some of the other nostrums that might be suggested to you within the Fed. I have several questions. First one having to do with what's happening in the economy right now and the impact on the federal budget. We were told that we were going to have a $124 billion deficit this year. It's going to come in now at something less than $100 billion shy of that, which is very good news. The President takes credit for it, as I would if I were President. We Republicans give you the credit for it, as naturally we would do if we don't hold the presidency. I think probably the real hero here is neither the Congress nor the Fed nor the President, but the economy itself that is growing at a rate that nobody really had foreseen, and that's always good news. We're going to be faced with the challenge in the Congress next year, if we don't have a recession, of dealing with the unexpected and, for all of us, except possibly Strom Thurmond, unexperienced circumstance of a budget surplus. And we will argue mightily among ourselves as to what to do with that money. Some say give it back to the taxpayers. Some say raise spending in social programs. Some say pay down the deficit, pay down the debt. Do you have any views as to what we might do with the surplus?
As I testified before the House Budget Committee earlier this month, I thought that it would be quite useful to allow, at least in the beginning, for the surplus to in fact occur, meaning indeed it just reduces the level of debt to the public. If, as I said earlier, we are beginning to become far more secure in our view that low inflation brings down inflation premiums and long-term interest rates, and that in turn is a major factor in economic growth of a sustainable type, then it's pretty obvious that to the extent that we are reducing the federal debt to the public, to the extent that we're doing that, we're also likely lowering the inflation premiums embodied in long-term rates. So it's quite conceivable to me that if we allow at least a significant part of this excess of receipts over outlays to end up as a reduction in the debt, we may find that we have created a very effective economic policy. And while I, as you know, am strongly supportive of endeavors to cut marginal tax rates, and have even argued beyond what most people are willing to argue, namely that I think the capital gains tax ought to be eliminated, I nonetheless believe that we've built up a very substantial amount of debt in this country, and I am not one of those who believes that that is irrelevant to what the inflation premium is in interest rates or in the growth of the economy. So I would be cautious about dispensing something we don't have yet, and if it turns out that we get it, it's not the worst thing in the world to lag a little bit in responding in a way to dispense with it. There is no urgency of which I am aware which suggests that if we inadvertently fall into a surplus because receipts turn out to be even still higher than we've been projected, that is, I know of nothing that goes wrong which requires us to address. I grant you it's a wonderful pot of money for many different types of projects, but that is something that the Congress is going to have to make a judgment on.
Thank you. I have exactly the same instincts that surplus should go to pay down the debt, and much as I am in favor of reduced tax rates too, I think we do that by restructuring the whole tax code. I think it is an abomination, even though I voted for the latest addition to it that makes it even more impenetrable. And just note, Mr. Chairman, Chairman Greenspan and I have a ritual that has gone on ever since I've been in the Congress. At some point, I always ask him what he thinks the appropriate rate is for capital gains. And he solemnly tugs his cheek and says, I think it probably ought to be 0. And we've gotten it down to the point where he did it automatically without having the question here today, and I'm grateful.
Thank you very much, Senator Bennett. Senator Sarbanes?
Well, thank you, Mr. Chairman. Chairman Greenspan, welcome. I regret very much that I missed the spina bifida roast that took place last night here in town, because I understand Andrea Mitchell gave us a lot of clues on how to interpret your comments. And unfortunately, I wasn't there, so I didn't have the benefit of it, but they tell me C-SPAN carried it, and maybe we'll study very carefully what Andrea had to say, and we'd be in a better position to interpret you when you come before the committee. I guess you don't have to respond to that if you don't want to.
I felt an obligation to, but I appreciate not having to.
I'm sure the context for today's hearing is quite different than what you anticipated when you accepted the committee's invitation to testify. And of course, a lot of the focus has been on the developments in the stock market over the past few days. However, I wanted to go beyond these immediate events and talk a bit about the underlying condition of the U.S. economy. Because it seems to me that looking beyond the developments of the past few days, the basic condition of the U.S. economy continues to be exceptionally good, and I think you indicated as much in the course of your testimony here. Growth has been steady, unemployment low, and inflation is declining. Let me repeat that. Inflation is declining. In the first 9 months of this year, the Consumer Price Index is up at only a 1.8% annual rate, well below the 3% rate that we were bragging about last year, and which was, I think, the lowest in some 25 years. In fact, this is really a very impressive performance, as we can see, with this year's performance over there on the far right, and we have to go back into the mid-1960s to have anything comparable. Now, even if we exclude food and energy, and I'm not going to show that chart, but the core inflation is up at only a 2.2% annual rate. Producer prices are essentially unchanged over the last year, and this is 1990-91, and that's where we are today, which I think is a pretty spectacular performance. And the thing that my colleague, Congresswoman Maloney, touched on, which was unit labor costs, are only up 2.2%, consistent with the rate of inflation. I mean, this is the unit labor cost performance. So that, all of those, I think, are pretty dramatic examples of the context of a declining inflation rate we're now experiencing. Now, the point I want to get at is that given this, the Fed's current posture of holding the federal funds rate constant at 5.5%. You took it up, I think, last March. Was it a quarter of a point?
That's correct, sir.
Means that real interest rates are actually rising. And I think it's very important to think in these terms, because there's a tendency to see the Fed's holding the rate, the nominal rate, at a constant level as not representing action on the monetary front. But if in fact the inflation rate is declining and the nominal rates are held constant, you're going to get an increase in real interest rates. And that's shown in this chart, which shows that the real fund rates is on the increase. This is 1994 back here, and we see the fund rates now moving up, as it shows at the far right of the chart. In fact, the real fund rates is at the highest level since June of 1990, a month before the recession began. The 1990 recession, 1991. And what we have, and what I'm concerned about, I don't want to see happen again, is the real interest rates were taken up quite high in '89, higher than they are now. Subsequent to that, we had a recession. You brought the real interest rates down, as that chart indicates. Now you're taking them back up again. And I'm concerned that they not go back up to the point where they trigger another economic slowdown and throw us back into a recession. The fact of the matter is what appears as a passive position on the part of the Fed with respect to interest rates, namely holding them at a nominal level, has been in real terms a restrictive monetary policy. A recent New York Times article entitled "Fed Policy on Rates Seems Tough After All" focuses on this often overlooked fact, and I'd like to insert that article into the record. In fact, the article points out that the minutes of the August meeting of the Federal Open Market Committee, released earlier this month, acknowledge the role of high real interest rates as a constraint on the economy. The Fed itself acknowledged that, and I quote from the minutes: "The level of real short-term interest rates was relatively high by historical standards, provided some assurance that the current stance of policy would not accommodate a significant increase in underlying inflationary pressure." I emphasize this point because before the events of the past few days, there increased speculation that the Fed might have to raise interest rates soon to offset inflationary pressures. That kind of speculation had started in the press. Now the press, most observers believe the events of the past few days make the outlook for an imminent rate hike less likely. But I want to emphasize the point that there is still no evidence of inflationary pressures, and that in fact the Fed has been pursuing a restrictive monetary policy characterized by rising real interest rates. Isn't it reasonable to focus on the real interest rates, or at least doesn't the point need to be made?
Yes, Senator.
That if the Fed holds rates constant and the inflation rate declines, in fact, the real interest rates are going up.
Real short-term rates,
Right.
Yes, indeed. Translating that statement, however, into an issue of the degree of tightness requires that you evaluate what's happening within the economy, especially in the interest-sensitive areas of the economy. If monetary policy were perceived of as severely restrictive, we would see the whole structure of interest-sensitive areas of the economy, housing, motor vehicles, and a number of interest-sensitive areas showing signs of contraction. We don't see that at this particular stage. Were we to see that, then we would say that it's pretty clear that the level of real short-term rates is beginning to grip. I think as a first approximation, I think it is the right thing to do to take a look at the historic relationship of the current real federal funds rate and history to get a sense of where we are in a general way. But that is inadequate as a measure to conclude the degree of restraint that we're imparting on the system. It merely says that if we begin to get in areas where it looks as though, in a historical basis, the short-term real federal funds rate is high, I think that accelerates our view looking at other areas of the economy which interest rates affect, both in the financial system and elsewhere. As you know, money supply growth has been somewhat stronger than we would have projected, which suggests that there is no particular restraint going on in the banking system. And when we ask very specifically in our senior loan officer survey of how the banks are behaving relative to customers, we don't pick up any significant degree of restraint there either. So I think it's an issue which, I grant you, requires a considerable degree of increased focus, but we want to begin to see the process beginning to show signs that that degree of interest rate is indeed creating a significant slowdown. The one area which I want to emphasize, however, is the issue which we're always confronted with, namely that there is a significant lead time between the actions that we take as manifested in the real federal funds rate and its impact on the economy. So to argue the other side of the argument partially, merely seeing concurrent evidence that there is no effect is not in itself necessarily conclusive. It is an important fact, however, that I think we ought to evaluate.
Yeah. Well, Mr. Chairman, in this article that I've submitted for the record,
Senator, if you would, obviously your 5 minutes is long since passed, and we have other members who are waiting patiently, so if you would conclude.
I'll just make this observation, that between the Fed's quarter-point increase and the sharp decline in inflation this year, that the federal funds rate is up from 2.22% in February to 3.28%. So it's gone up by more than a point in less than a year's time. Now, when the bite will come, I don't know, but I think it's important that we get it out in the public and recognize that when the Fed holds interest rates constant and inflation is declining, the Fed in effect is tightening because real interest rates are rising under that circumstance. Thank you, Mr. Chairman.
Thank you. The gentleman from Louisiana, Mr. McCreary.
Thank you, Mr. Chairman. Chairman Greenspan, I want to shift gears here for just a minute and talk about trade. Does the recent turbulence in the Asian currencies and the Asian markets underscore, in your opinion, the need for our president to engage in trade negotiations under fast-track authority?
I think that the evidence in the post-World War II period has been fairly conclusive that the quite marked expansion in trade, I'm not talking about the United States so much as everybody, has really had a pronounced positive impact on rising standards of living. We are a very major player, obviously, in the world trading system. I think we benefit immeasurably from it. Previous presidents have very readily been able to obtain fast-track authority to negotiate for very obvious reasons. You just cannot negotiate if you're not the final negotiator. And I think it is very important that the president be accorded fast-track authority, not not necessarily because it reflects individual negotiations or the like, but I think it's the right thing to do because it's really in the interest of this country to be in the forefront of expanded trade, and one vehicle which enables us to do that is to have a negotiating authority for the President, which enhances his capability to obtain increased opening up of markets where we would otherwise be constrained.
Thank you. And now I'd like to get back to Senator Bennett's question about the surplus. I'd like for you to expound a little bit on your answer. In answering the Senator's question, you said that while it would be nice to lower the tax rates and even go to a zero capital gains rate, we've built up a substantial debt, and it's probably in our interest to address that sizable debt. But in fact, if the current debt was all we had to worry about, I would be much more inclined to use some of the surplus, or perhaps all of the surplus, to reduce tax rates or even spend the money on transportation infrastructure or other needs. But as I look down the path into the next century, I see that the current debt is not really the only thing we need to worry about. Could you expound upon that? Does that have something to do with your inclination to spend the surplus, so to speak, to buy down the current debt?
It certainly does, Congressman. I think that the few things we can forecast in the future is the structure of our population. And under existing law, Social Security system, as you know, creates a trend in benefits which accelerates very significantly starting in the latter part of the first decade of the 21st century. And that continues to move at a very rapid pace. As things now stand, unless we either create a chronic surplus in the non-Social Security area or significant changes in Social Security, we are going to run unified budget deficits which are going to be exceptionally difficult to finance. And how one tracks into that period, which accelerates pretty fast, is going to really matter. So if we are in a position where we're coming into the year, say, 2007, with a significant surplus, we'll eat into that surplus very quickly in the next subsequent 10 years. So it's going to really matter whether or not you come in at a low level, either a deficit or a small surplus, or a significant surplus, as to how easy the transition is going to be. There is no way to get around that problem, and I think that it's by no means too early to start to think about trying to resolve it, because it is it's only 10 years away. 10 years in this, for this type of problem, is a very short period. If we don't address it now, the political consequences, I think, are going to be terribly destabilizing to the society, because you're going to force a wrench between the younger people in our society at that time and those who are in the process of retiring. I know of nothing which could do more damage to the structure of this society than have that type of confrontation emerge, and it will, unless we can confront this issue sufficiently far in advance and enact legislation today which becomes effective then. It's far easier, as you well know, to do something now which doesn't affect anybody for 10 years than do something which affects them tomorrow.
Yes, sir. You mentioned the effect that the aging of our society is going to have on the Social Security system. You didn't mention, but well could have, the Medicare system and the Medicaid system as well.
You're quite right. I forgot to mention that, and that's, in a certain sense, from a statistical point of view, an even greater threat to the budget.
Well, one last comment, Mr. Chairman, and that is that, again, echoing Senator Bennett's comments, I think maybe we could have it both ways. If we junked the current tax code and went to a different tax system, we might be able to have a zero capital gains rate, a tax system that would promote growth and at the same time use the surplus to buy down the public debt. Thank you.
Thank the gentleman from Louisiana. I'd now like to turn to the senator from Florida and thank him for his patience and waiting so long for his opportunity to question the chairman. Senator Mack was, incidentally, as everyone here knows, the chairman of the Joint Economic Committee in the 104th Congress. So it's good to be back here with you today, Connie.
Thank you, and I appreciate your kind comments earlier this morning with respect to the work that we've done together on trying to focus on the issue of price stability as being the primary goal of the Fed. I've enjoyed working with you and appreciate your leadership. Mr. Chairman, I think, frankly, most of the questions that I had in my mind have been raised here this morning already, but I think that I can focus a question or two back on what has been on the minds of the American people the last couple of days and raise a question from this perspective. Given the experience with Mexico a few years ago, and I remember in our discussions about that, it really raised for the first time the significance of the interdependence among nations from a financial economic perspective. And I think it's probably fair to say that what's happened in Asia is another example of that interdependence. And what it raises in my mind is, are there new obligations, responsibilities of the Fed, of the Treasury, of international financial institutions to deal with this greater dependence that we share now with other nations and other economies? It may be too early to conclude what that should be, and if that's the case, I would be interested in what do you think the proper forum would be to begin the discussions of the development, if necessary, the development of ideas about the roles that the Fed should play or that the Treasury should play and other financial international institutions.
Yeah, Senator, I think that's a very important issue. What technology is doing is positioning the United States and indeed all of our trading partners such that we all affect each other increasingly than in the past. In other words, if you take the ratio of trade to gross domestic products, it's rising, the ratio is rising quite significantly, meaning in effect that on average both exports and imports for everybody is becoming ever more important with each of us. To the extent, therefore, that difficulties arise in individual countries, we're all affected. There's a contagion effect which is not unrelated to this increasing globalization. I think it therefore is incumbent upon all of us to recognize that and to try to take actions which effectively restrain the consequences of mistakes, but more importantly find means to prevent them from happening. I think we have an unofficial forum at this stage, which is a continuous interaction within the United States, for example, between those agencies which are related to this question, mainly the Fed and the Treasury, but also State Department has got interest. The White House has an interest. I mean, there's a general interest here in which we go forward in endeavoring to find the appropriate interface with our trading partners. Obviously, the trade representative is a crucial operator in this regard as well. What the ultimate project should be is hard to say. The one thing you have to be very careful about is the one thing we don't want is some supranational financial or trade authority which has impacts on the sovereignty of the individual nations. What we want, and indeed what I think is evolving, is a voluntary association where we meet as the G7 or the G10 or in the Bank for International Settlements or other groupings in which we discuss various bilateral, multilateral issues which are of interest to all of us. And it is not a zero-sum game. In other words, if it were a zero-sum game, then we would be finding we would be at loggerheads with each other because your gain is my loss and vice versa. What we have found, however, is that there is a net positive sum. And the question is, we will all benefit, and therefore we all have a very strong interest in seeing that trade proceeds and that the international financial system, whose basic function is to facilitate that, function in its most effective manner.
What I hear you saying is that that there is a natural evolution taking place within the present institutions that, at least for the time, are addressing these issues and at the present time seem to be adequate to deal with these various crises that come up. That's point one, and one additional question to raise is having to do, again, with Asia. I think that that the stock market, in a sense, is kind of reflecting a process that most investors went through. Can really raise the question about how significant an effect the actions in Asia will have on our markets. As they went through that process, the market turned around because the conclusion was it's a relatively small impact on the American economy and the American markets. But the question I have, and then I'll conclude, is what effect will this Asian problem have on Japanese financial institutions, which I understand presently are experiencing some fairly significant difficulties, and how can that or will that have an effect on the U.S.?
Well, as you point out, Senator, they are having problems and have been ever since the collapse in property prices in Japan. And not unlike many of the smaller Asian nations who have had real estate collateral as significant elements within their banking system, the Japanese have been struggling with that problem and working to solve it with some success in recent years, but they have found, as we found during our credit crunch, where we had the same thing, as you may remember, back in 1990-91, real estate is a relatively small part of most economies, but it ends up as a significant part of the collateral in the crucial banking system, which impacts the whole system. To the extent that Japanese banks are involved in lending to property in a number of these different Asian areas, and they are to a certain extent, then clearly, unless and until that issue gets resolved, it would have more of a negative effect on them than on us. And obviously they are aware of that, and I think that we're all aware of the notion of the significance of property values throughout Asia. To the extent that it impacts negatively on Japan, which is such a potent factor in Asia, obviously it impacts us, as indeed the difficulties with any of our major trading partners creates problems for us, so that as far as we're concerned, it is not an issue that we look on without interest or concern. We are interested and we are concerned, and we would like to see the issue resolved as quickly as possible to bring down all of the latent risks that have emerged in this contagion problem that I've discussed in my prepared testimony. And I think that there's an awful lot of work that's moving forward in that, and I just wish to emphasize that while we may not be directly involved in a lot of it, we do have a significant interest that it gets resolved effectively, because if it does not, then I think the impact on us becomes immeasurably larger.
Thank you, Mr. Chairman. Thank you.
Thank you very much, Senator Mack. We're going to move now to the gentleman from South Carolina, Mr. Sanford. But before we do, let me just announce that Mr. Sanford will be our last participating questioner this morning because of scheduling considerations. And so, Mr. Sanford, we're anxious to move on and hear your questions at this point.
Thank you, sir. I have but two questions, Mr. Chairman. One would be tied to I was noticing here in the second page of your testimony, yet provided the decline in financial markets does not culminate, and then it went on to say, we'll look back at it in many of the same ways that we look back at, for instance, 1987. My question, I guess, is, doesn't it have to culminate, if for not one of maybe two reasons? Either because of the length of this expansion, which I understand to be about 6.5 years, which, if not at, very close to a post-World War II record in terms of length of time on expansion, or if not for that reason, because there are no magic errors. I don't know if you saw the article a couple weeks ago, maybe a month ago, in the New York Times or the Washington Post. It talked about technological advancement, and that while much of the earnings projection was based on technological advancement within our society, what the article pointed out was that technological advancement was a relative thing, that in the same way that telephones had been a tremendous technological advance at the time, now computers were, but relative to our economy, they were not life-changing, and that therefore there were no magic technological new eras. If either of those two happen, does that mean that we go back to the markets culminating? And if that happens, what does that mean?
Well, I read that article, as I recall. I thought it was quite interesting, and I think there's a substantial element that I think is important to recognize. I think, however, that the issue isn't whether we're dealing with an explosive new technology far greater than in the past. Indeed, as I think that article points out, that productivity growth in the 1960s was significantly higher than it is today, and that's factually the case. The issue that is involved here is that we're going back to an ever-increasing globalization, which we really haven't experienced for 100 years. We had a very substantial free world system at the end of the 19th century, and then it, especially after World War I, it began to get narrower and narrower, and then with the Depression, we all just shut our doors. You know, we had Smoot-Hawley, and everybody pulled in their horns, and it was an autarkic society. We're reversing that, and I think it's tremendously beneficial. And in that regard, the technology changes are impacting to a greater extent on financial areas, and indeed changing the basic structure of finance. So in that regard, I think these are really quite unusual changes, and in the sense that if you go back to, say, the Mexican crisis of the early 1980s, its impact was nowhere near the more recent impact, largely because we're dealing with a far more open world system, and I think that that changes the scorecard, so to speak, in an appreciable way.
My second question was unrelated, and that goes back to what Mr. McCreary was raising on the issue of Social Security, and that is, I guess, two related questions. One is, do we in fact run a surplus? In other words, Washington may proclaim this year or next year that we've run a surplus. Do you think we really in fact run a surplus, given the way some of the money's moved around within the unified process? And second, and tied to that, is, I mean, for instance, we introduced today a bill on Social Security. What do you think might be the right prescription for saving Social Security?
Well, I think, first of all, There are many different definitions of surplus. It depends what it is you're focusing on. We at the Federal Reserve are very focused on the issue of what is the amount of new debt issued to the public. That is effectively the unified budget deficit. And so far as financial policy is concerned, that's the crucial measure.
But then at some point, don't the financial markets begin to take into effect the contingent liability?
I was about to raise, and that's a very interesting and very important point. We have something of the order of contingent liabilities on our existing Social Security system in the amount of $9 trillion. Now, it's not exactly the same sort of commitment that say, a U.S. Treasury bond is. That debt, by any of our customs or any of our laws, is irrevocable. We will pay interest and we will pay it off. The contingent liability, however, on the Social Security system is a somewhat lesser type of obligation in that the Congress has the legal authority to alter the pattern of both receipts and outlays in the future and change that number. So it doesn't have exactly the same force. What we don't know and are very interested in is how the markets view that. I mean, because as you know, there are lots of questions about how to reform Social Security, and one of them is to go in the Chilean direction, which essentially would have recognition bonds, which would mean effectively that that $9 trillion would go into non-marketable securities owned by individuals, with probably they would be zero coupon bonds or something of that nature. Now, how that impacts on the financial markets, dollar for dollar, vis-a-vis the regular debt that we publish, we don't really know. We suspect, obviously, that it is less, but we don't know how much less. If it were a small number, we wouldn't care, but it's $9 trillion. And a small part of $9 trillion is a very large number. So that is an issue which we are puzzled about, and you're quite right to raise the issue of a different form of measure of surplus. If you put the contingent liabilities in, then we're running a deficit. And the question is, it's a different definition. It means something different. And I wouldn't say that it is necessary for the Congress to have a single definition. There are multiple purposes which the Congress addresses, and you would want certain things to you could very readily want certain things handled in different ways. But this whole question of Social Security reform has raised a large number of issues which we really haven't focused on and really had better do sooner rather than later.
Thank you, sir.
Thank the gentleman from South Carolina for his questions. Mr. Chairman, thank you for being with us here today, and in particular, I'd like to thank you for your candid discussion relative to the Fed perspective, or your perspective at least, of issues involving inflation and price stability. I thought that was very enlightening, and I'd also like to thank you for your willingness to discuss today's economy and the economy as you see it, prospects for the economy in the future, as well as Social Security and other matters. Thank you very much for being with us today.
Thank you, Mr. Chairman.
The committee stands adjourned.
Good job.
Thanks, dude.